Welcome to the Silverbridge CPAs Summer Speaker Series. We hope you enjoy this message.
Firm administrator here at Silverbridge. We are very fortunate to have Silverbridge CPA's very own Dena Shipton presenting today. Dena will provide an overview of financial reporting and guide a practical discussion of what to look for when you review financial statements. I'll introduce her shortly, but just a few items to go over first. If you haven't already, please be sure to mute yourself. You can do so by clicking the microphone in the upper right-hand corner of your screen. This presentation is being recorded, so it looks like everybody has their camera off, but just so you remember, if you don't want to be on camera, to keep that button pushed for the camera off. You are welcome to type your questions as you have them into the chat feature. So that's also should be on the upper toolbar of your screen. There's a little bubble that says chat. If you click that, you can type in questions as you have them throughout her presentation. We'll try to save about 15 minutes at the end for those. And then, if we get through those chat questions by the end, you're more than welcome to kind of unmute yourself or raise your hand and ask questions that way as well. So with that said, I will go ahead and introduce our speaker. Dena has more than 20 years of public accounting experience and has worked with individual and business clients in a broad range of industries, including grocery and convenience stores, construction, and rental real estate. Dena earned her Bachelor of Arts degree in psychology from Cornell University and completed her accounting education at Boise State University. Both areas of study have served her well in her career. Dena has lived in the Boise area for more than 20 years and enjoys watching her community grow and evolve. She believes it is important to give back to the community and does so by serving on the board of directors for a local nonprofit and by supporting various charitable organizations throughout the Treasure Valley. She loves live music and spending time with friends and family. All right, Dena, I will go ahead and turn it over to you.
All right, thank you so much. Hello, everyone. Thanks for being here. As Brittany said, I'm a CPA here at Silverbridge CPAs. It's a wonderful place. Thank you all who have joined today. We are going to talk about financial statements, and we are going to focus. My presentation really is very much focused on nonprofits and nonprofit boards. And we're going to spend some time talking about what it means to be on the board of a nonprofit and why financial literacy matters when you're on the board of a nonprofit. We're going to spend a fair amount of time. I do want to say this is a broad topic. There's a lot to cover, and we have a lot to get into this next hour or so. And so it'll be pretty high level. We're not going to get in depth. There's lots of resources out there if you want to dive in a little further, but this is meant as an overview, and it's meant for people who maybe don't have a whole lot of experience. It's not really geared towards someone who's an accountant. It's geared towards someone who maybe has different experiences and is either on a board already or looking at joining a board, or if they're involved with a nonprofit, maybe they're involved with a nonprofit that's looking at sort of stepping up its board game a little bit and optimizing its board and making sure it has the right people. So having said that, I think I want to start with a little bit of a question before I start sharing my slides and diving in. And my question, I'm going to have 3 questions. Give me a hands up if any of them apply to you. And the first is, are you already on the board of a nonprofit? Anyone? Put your hands up if you are.
And just so you all know, you can do that by clicking the raise your hand button up at the top. There's like a symbol of a hand. So you just want to click that if you are.
We got one. Anyone else? All right. Anyone considering joining the board of a nonprofit? Got a few more there. Okay. And then anyone who is maybe employed by a nonprofit or otherwise involved with a nonprofit, they're sort of looking to figure out how to optimize their board and what the best practices are for putting a board together. Excellent. Okay. So we have a few of you out there. My experience, as Brittany says, is primarily as a CPA. I'm a CPA. I've been a CPA for a long time. I work primarily with businesses. I don't do financials or tax returns or anything for nonprofits. But having said that, I have been on a nonprofit board. Actually, oddly enough, I'm not on one right now, but the only reason I'm not is because I timed out of my term, of my most recent one. I am still involved with the organization, and I'll probably roll back on the board, but they're making me take a year off, because that's one of the requirements. That's a pretty common requirement. But I've been involved on nonprofit boards for probably most of my 20 years here, as a CPA. And I find it very rewarding. I love being involved in the community. I think community involvement is really, really important. And so to the extent that I can give back, I really enjoy it. And I find it really satisfying, fulfilling. So with that little bit of my opinions, let me go ahead and start sharing some slides, and we'll just jump right in. Bear with me here. Find my let's see. We're gonna start. I have a couple different okay, that wasn't on. Well, we'll see what happens. I have a couple different slide presentations we're going to talk about. And this first one, the first section, obviously the title of the presentation is Understanding Financial Statements for Your Organization. And I would say too, though, that even though this is geared towards nonprofits, there's probably going to be some information if you're a business owner or otherwise need to read financials. Hopefully there'll be some things that you can take away from this that are useful, even not in the nonprofit context. So here's our agenda. We're going to talk about some board considerations and what to think about in a board, and what I think a board should look like, that I think is important. And we'll talk about fiduciary responsibility, which is the why you should care about your financials. And then we'll spend some time talking about financial statements. We'll get through as much of this as we can. If we can go through some examples at the end, we will. I would also like to say, excuse me, just to keep in mind, this presentation is really based on my experience and my experiences and my thoughts and my opinions. There's a huge range when it comes to nonprofits. They come in all shapes and sizes. They are big. They can be big, small. They can have lots of different focuses, and so I have put this presentation together reflective of my experiences, and other people's experiences may differ, and other people may have different input and different thoughts on things. But these are what I think are best practices. So the first things I wanted to spend a little time on is just board considerations. What do you think about when you put a board together, when you're on a board? And these are some of the points that I think are really, really important. It's important that you have at least, you have a majority of your board members be independent from the organization. And this is actually an IRS guideline. And what that means is that the board members should not be compensated, or if they are, the compensation probably isn't particularly meaningful. They should not have any conflicts of interest. So, you maybe don't want a board member who also is a significant business partner with the organization. That's a sort of a red flag there. Doesn't mean it's excluded. It just means proceed with caution. Unrelated. So no family members of the employees of so you don't want, say, the executive director's brother on the board, maybe. Some just you want some people who can look at things fairly objectively, look at the workings of the organization objectively as possible. Diversity on a board is also really important. And by diversity, I mean, just a variety of different backgrounds and perspectives and experiences and expertise. The nice thing about being on a board is, in general, unless things are really dysfunctional and really go sideways, which does happen, but hopefully you're not there, everyone sort of has this common mission, right? People don't join the boards of nonprofits because they don't like what the organization's doing. They join the boards of nonprofits because they care about the mission of the organization, and they want to support it, and they want to give back. And so everyone has a common mindset there. They might not all agree on how you get there, but that's a kind of can be a really important discussion because a lot of different viewpoints, especially if you have an organization that is serving maybe a lot of different populations or a lot of different members of the community, you want some perspectives that vary. That can be really helpful. You got to be a little careful. You don't want a lot of conflict and you want to get stuff done, but it can be really helpful. The other thing that's really helpful when it comes to diversity is considering whether or not the organization needs a specific expertise. So, you know, for example, maybe an HR person would be a really great person to have on a board, or someone if you have an education component to your nonprofit mission, someone from the world of education and maybe a couple different levels of the world of education, depending on what you're doing. So just consider that. The board has to be primarily focused on the organizational mission. They have to understand the mission, and that is their whole goal is upholding that mission and making sure that it gets accomplished. And this one can sometimes be a little tricky, especially in the financial realm, because a lot of times people join boards and they have maybe a really solid business background, and they can be when you have a business background like that, a lot of times what you're focused on is profits and how do we make money and how do we maximize that. And shifting from a focus on profits to a focus on mission can be a learning curve. That can be a little bit of a challenge for people. So we'll talk about that a little bit. It's important when you're on a nonprofit board to understand who your stakeholders are. It's not an owner. It's the donors that contribute the funds that allow you to pursue your mission. And it's the folks who receive the benefit of the services you provide or whatever it is that you provide. Those are your stakeholders as opposed to owners and people looking for a return on our investment or banks or something like that. And then you have to understand the financial goals and responsibilities, which for the board is to ensure that the organization has enough resources to do what it's set up to do, and it uses those resources in a way that really primarily further that mission. So one of the things that's important there is as a board member, you pay attention to how high are your administrative costs as opposed to the costs that are directly mission-based. The board evaluates the programs to make sure that they're aligned with the mission, and donors will look at your proportion of administrative costs to functional costs too. That's an important metric, and so that's one of the things that you'll look at if you're on a board. Moving forward, with specific to financial oversight, all board members in a financial oversight role, I'm going to read here, should understand financial terminology, be able to read the financial statements and identify unusual activity or items, evaluate trends, and know when those trends might indicate a change in the overall health of the organization. And critically, board members have to be able to identify questions and be willing to ask those questions of management or of the executive director or whoever it is. It's really important. That gets back to that objectivity. If you don't understand something in the financials or something looks off, you have to be able to bring it up. Now, I will just point out here that a lot of times what'll happen is you'll have you can designate someone who has financial really specific and deep financial knowledge, like a CPA. So for example, I don't think I have ever been on a board where I haven't been the treasurer because I'm a CPA and CPAs get to be treasurers. And that's an important function. Being able to rely on third parties or know when you need a third party is a really important skill to have when you're serving on a board. But having said that, all board members do need a certain level of financial knowledge and understanding of terminology and the ability to look at the financial statements and identify things. But you can delegate that really deep dive into the financials to a finance committee or a treasurer, depending on the size of your board. You can do that. So let's talk a little bit about the why of all board members need to have some familiarity with an organization's financial information. And that is because of something called fiduciary responsibility. It's probably a term you've heard a lot about. It's hard to know what it means. But basically what it comes down to is that board members have a legal and ethical obligation to act for the good of the organization and the public rather than for their own benefit. And notice that says legal because, yep, it's legal. So nonprofit organizations are granted tax exempt status, which we know, and fiduciary responsibility has to be honored in order to maintain that status. The organization can't profit for profit's sake. All income that it generates has to be used to further the exempt mission. So, and that's something that the IRS takes pretty seriously. The IRS isn't out there monitoring, so the board is ultimately responsible for making sure that the financial reporting requirements are met and that the resources are used properly, that the executive director and the staff of the organization are acting in service of the mission. And the executive director and the staff answer to the board. There aren't any owners. We've talked about that a little bit. So this is really, really important. And this is the crux of why you need to care about the financials of the organization, not just from an ethical, but also from a legal perspective. So there are 6, I'm going to flip back one thing. Okay, so if I talk about fiduciary responsibility, I apologize. I want to go back just a little bit. If this is a legal responsibility, it's unusual. There has to be some negligence or something for there really to be legal ramifications, but it can happen. It's shared among the board members. But it also can extend to them personally, and some larger nonprofits even have directors and officers insurance just because of this. And it provides for protection of the organization's assets from the misuse of power, prevents conflict of interest, provides greater transparency and accountability, promotes a higher level of professionalism for the organization's leaders. So I think we get it. This is important. That's what I'm trying to say there. There are 6 total fiduciary duties that are specified. We're actually only going to talk specifically about 3 of them today. They're kind of overlapping, and they make sense, but they are kind of overlapping. So we're going to talk about the duty of loyalty, the duty of care, the duty of obedience. There are 3 others. There are also the duties of confidentiality, which means you gotta keep some things out of the public eye where warranted. If you have confidential information about donors, for example, or things like that, you can't go telling everybody. There's prudence, the duty of prudence, which is risk management. You have to act in a way that does not take on undue risk for the organization. And then a duty to disclose, which is a transparency. So you have a duty to the other board members to disclose something if you know that you know something important. But let's focus on duty of loyalty, duty of care, and duty of obedience. Directors must always act in the organization's best interest. Hard stop. You can't use, for example, your relationship with the organization to primarily benefit your business. So you can't, profit from your position as a board member. Doesn't mean that you can't do business with the organization. There's sort of some subtlety there. But you do, if you are going to do business with the organization, you need to put the organization's interests before yours. And this is an area that a lot of times will warrant some extra scrutiny, either from the rest of the board or from the management of the organization, to make sure that this is being honored. You'll probably be asked to sign a conflict of interest waiver, and it sometimes there's some nuances and some subtlety here, but really your job when you serve on a board is to put the organization first. Duty of care. Directors are stewards of the organization, and they are obligated to act in their at their highest skill level, and use due diligence and be professional when they do their job. And this can mean, like, you got to make sure you participate actively in board meetings and serve on at least one committee and be involved. And you work to advance the nonprofit's missions and goals, and you practice oversight of programs, and you choose a qualified executive director, because that is the board's responsibility, is to choose the executive director, and just really being thoughtful and careful in how you carry out your board obligations. From a more financial perspective, you have to have a significant understanding of the operations of the organization and how the financial information comes together, so that you can make informed decisions about how the resources of the organization are used. If you don't understand how the resources are generated and how the financials are put together, it's pretty hard to make any kind of recommendation or decision about how you use the organization's resources. Continuing with duty of care, specifically, you're required to monitor the budget and the financial reports. We'll get into the budgeting a little more later. Question unusual financial transactions, assist with establishing controls. We'll talk about that a little bit. Consult third-party experts. And this one's important. I think we talked about this a little bit, but you do want to, if you don't have the expertise, you want to go outside the organization and hire someone who does, or recruit somebody who does have the expertise to deal with a specific situation. Duty of obedience, you have to safeguard the organization's mission. As we said, the board is accountable. They're the ones. And you have to make sure that the organization adheres to it. The organization can still evolve, but it needs to stick to its originally granted exempt purpose. And if it strays too far from that, then there's some things that might need to happen, the IRS might need to know about. So that is that. And then let's look at, I'm going to speed up a little bit here because we are going to be short on time. I have a lot to talk about. Budgeting. So board is responsible for, at a minimum, reviewing and approving the budget each year. And so you have to have a certain level of understanding of the organization and understanding of the financials and all of those things, so that you can evaluate whether or not that budget makes sense and whether that budget is aligned to the mission. And just a reminder again that performance is not really measured by net income, but what you're trying to do is make sure that the organization is generating enough income so that it can fulfill its mission. So that's really the goal of your budget. They're not maximizing profit. Payroll and compensation. The board is often involved in payroll, usually not with specific people other than the executive director. But maybe they're involved in setting salaries for specific positions, not for people necessarily, but for positions. A lot of times the board really is focused on compensating the executive director. It's their job. They're the boss, the executive director, and they provide an annual review and set salary, and they should be a resource for the executive director and provide guidance. And so, mentor if need be, if there are changes that need to be made. Accounting and reporting. They are board members, as I said, are responsible for the review and oversight of the organization's financial reports and tax returns. We'll talk about the financial statements a little more in depth in a little bit here. Not all organizations have financial or audited financial statements, but a lot of them do, especially if they're larger. And so, while the board is not responsible for actually doing the audit, the board is responsible for hiring the firm that audits them. They are responsible for reviewing them with that firm and understanding there's some attestation that needs to happen when you are in an officer's position on the board, that when it comes to audited financials, so that can be important. Then the income tax filing. The income tax filing is public information. And it contains a fair amount of information. It has information on the current and prior year financial results. It has the mission statements in there. All the names of the officers and directors, so the board of directors are in there, and any compensation they receive. The executive director and executive director's compensation. There's revenue broken out by various sources: operational, fundraising, grants, contributions, operating revenue. So it's designed, expenses the same. It's designed for someone to be able to look at and evaluate the organization and see how efficiently it uses its resources, and probably, especially if it's a donor, look at whether or not they want to make a contribution. So donors look at these things. Let's see. Oversight and protection of resources. So this really is a huge part of the board's job. This is what they do. They're authorized by the IRS to solicit and spend money that doesn't really belong to anyone, it belongs to the public. They have an obligation to protect these funds. And there can be conflict here, it's especially if someone donates money and then the organization and says you need to use this money in a certain way, and the organization doesn't follow through on that, doesn't uphold their side of it, there can be problems. The donor can take their money back. I don't know if anyone remembers, but in the early 2000s, Garth Brooks made a pretty significant donation to a hospital in his hometown, with what he thought was the stipulation that they build a women's center in his mom's name. Now there was no written document, but he thought he had a verbal contract. The hospital, needless to say, did not use the money to do that, and Garth sued and got his money back. And the part of the board's job is to make sure part of the problem with this lawsuit was that there was no formal documentation around the restriction on that money. And, maybe it's good practice to put in some processes that require structure around large donations or all donations, and consideration of whether you want to accept a donation and things like that. Garth did win that, by the way. He got his money back and then some. So it happens. You have to be careful. Oversight and protections of resources. So this can be kind of tricky. How do you do that, right? What are some practical ways to do that? And I would mention here that larger organizations are probably going to need more controls because they have more resources and more risk. But smaller organizations should also pay attention. And there are some things that you can put into place that are really cost effective and can go a long way. The biggest one, this first one, cash controls. Nobody ever counts cash alone, ever. Don't do it. And that's so easy to implement. Just two people, make sure there are two people in a sign-off procedure, and you have a witness. So, and then disbursement controls, two signatures on a check, a review and authorization, some bank statements. If you just have someone review the canceled check and it isn't the same person who's writing the check, that can go a long way. And then this, I just sort of alluded to policies that are in place about how funds are spent and what purchases are made, and when does the executive director ask permission from the board to spend money, because sometimes that happens too if it's over a certain dollar amount. And setting that dollar amount can be a challenge. So there's a lot to consider here. And this can be a tricky subject, because especially in a smaller organization, implementing these policies can feel almost accusatory, especially if there are people who have, say someone has counted the cash by themselves for 20 years now. They're going to feel, there's potential for them to feel like they're being accused of wrongdoing if you suddenly say, you know what, we're going to change our policy a little bit. And I think that messaging can be tough, and navigating that communication a lot of times can be made easier if you focus on the fact that the policies actually protect that person who is doing that thing without out of control in place. They protect the organization, they protect that person in the event there ever something goes sideways or they're accused of wrongdoing. But that can be, I just wanted to acknowledge that can be a really hard thing to navigate from a communication standpoint. But the goal really is to be transparent about how the resources are used and who uses them. So that's that. And here are some specific questions that board members should ask as they evaluate financial statement. And you can go through these. They're really based on big picture. Is the organization's financial policy and outcome and all of that in line with the mission? And is it set up to maximize the chances of the organization fulfilling that mission? And it's important for a board member to keep these sort of bigger picture angles in mind. It's easy to lose sight of that. And I also want to just say that, being a board member is not a passive activity. If you are on a board member, be involved and ask questions. We already talked about that. So I can pause there for just a minute. We're going to switch slideshows and talk more specifically about financial statements. But are there any questions at this point? All right, let's go ahead and switch and talk a little bit more about the specific financial statements of a nonprofit. So you can see we're getting more interesting because I changed the background on my slides. Understanding your financial statements. I wish I could guarantee that I'm going to give you the ability to completely understand them. We've only got half an hour left or so, so we're not going to get there, but we're going to do our darndest, and we're going to do some high level things. So financial statements, we talked before about the fact that boards or nonprofit organizations are all over the place in their levels of complexity and size and missions and things like that. So there's a broad range of financial statements too. There are some that are very, very, very simple, and some that are really complex. So if you're familiar with the terms cash versus accrual accounting, that can be a big deal. And we'll talk a little bit about those. But the smaller organizations really tend to sometimes just be a ledger with cash in and cash out. And they don't have audited financial statements. And so you might know the balance on the bank, and maybe if you have some debt, you know that. But other than that, you might not know, there might not be a whole lot to report. There are 4 different types of financial statements that are specific to nonprofit organizations. There is the balance sheet, which is actually for a nonprofit called the statement of financial position. There is the income statement, which is actually called the statement of activities. And then the final 2, the statement of functional expenses and the statement of cash flows, don't show up a lot. So we're going to focus on the first 2. The other 2 tend to show up in audited financial statements. And then some of this information shows up in the tax return too, the functional expense information. But we'll talk about the first 2 primarily. And balance sheet, presumably these are terms that everyone has heard, but maybe you don't always know exactly what they are. So we'll break it down a little bit. Balance sheet is 3 measures an entity's financial position at any given point in time. And so it's a snapshot, and it has assets and liabilities and equity. And in the nonprofit world, equity is actually called net assets. So we'll talk about that a little bit. Then there's the income statement, which in the nonprofit world is the statement of activities, and it measures an entity's financial performance over a period of time. That's revenue and expenses. So that's kind of high level where we are. If we move forward and we talk about we're going to talk about the income statement first. I know I presented them in the other order on that other slide, but we're going to start with the income statement because this one in some ways is the one that boards tend to focus on a little more because it's operational and showing results. Revenue minus expenses is equal to the change in net assets. And these are 3 different, it's called the income statement, the statement of activities if you're nonprofit, or the profit and loss statement. Those all basically mean the same thing. And the income statement provides historical information about the organization's operations. It doesn't provide any information about the future. It just says, okay, this is what we did over the last X period of time. It might be a month, it might be a quarter, it might be annual. It could be be pretty broad there. Revenue minus expenses equal to your net income or your change in assets. We talked about that. And one of the things that can be really useful is having separate income statements for maybe the different programs that the organization puts on, or maybe they have a fundraising gala. Well, you might want to put together an income statement specific to that year's gala so that you can see whether or not you made any money or generated resources that can be then used for whatever purpose you need to use them in your mission. So sometimes an income statement can be just a portion of the operations, and that can be really, really useful as a board member in understanding and evaluating the programs that the organization has. A lot of different revenue streams for the potential, but these are sort of the four common ones. Not all organizations will have these. You have operational revenues, so membership dues, service revenues, maybe there's a museum store that generates revenues. Contributions, so those are the obvious ones, so donations and investments and gifts, and these can be categorized as restricted or unrestricted, depending on what the donor has specified. Or if the board has self-restricted funds, that's also a possibility. Say they say they have a goal and they have a target they want to meet, and they have said, okay, we are going to self-restrict X number of dollars specific for that purpose. Grants, so these are foundations or a government entity, maybe depending on where you're getting your funding. And then fundraising and income, and that's your gala. That's where you're actively going out and putting on events or looking at specifically raising money for a certain thing. Each organization is going to have a different mix of these revenue streams depending on its own unique operations. But it's really important for an organization to understand and be able to evaluate their revenue streams to make sure that they meet the organization's mission and or generate enough funds to support that mission. You know, you might have a program that doesn't make any money and doesn't generate, it uses resources rather than generating resources. But that program might be really, really critical to your organization's mission. And so then, but you have to know that and you want to know why you're keeping that around. Whereas you might have one that maybe uses a lot of resources, but isn't quite as critical to the mission. Well, maybe you analyze whether or not you want to continue that program, whether that's worthwhile. And that's sort of some ongoing analysis that is really useful. And the board should be paying attention to that. Expenses are in similar categories to revenue, and like I just said, that can be useful in understanding how a nonprofit uses its resources. I talked a little bit earlier about administrative versus program expenses and how important that can be, and you don't want those administrative expenses to creep up too high. You want to keep that percentage pretty low because that's what donors will look at. How efficient are you at using the funds they give you in furthering the mission of the organization? I threw fixed costs and variable costs on here because they can be really useful when you're looking at things like budgeting and determining future funds that are available. Fixed costs are those costs like rent, insurance. They don't move around a lot and they're not necessarily tied to the business's activity level. Whereas a variable cost, maybe that's labor that if you have more visitors, you have to hire more employees, and so your labor goes up as your revenue is going up. And so those are two different kinds of costs it can be really useful to understand those and know how much of each the organization has so that when you're looking at the future and trying to figure out what kind of funds you're going to have available for your mission, those can be really handy to know. And then we have non-cash expenses. Depreciation is the most common one. And it's nice to have those in their own bucket on the income statement so that if you want to potentially estimate whether, how much cash you're going to generate going forward, you can pull those out of there. So that can be useful. Okay, so what exactly does this income statement tell us, and what do we use it for? Well, we need to know if historically the organization has generated net assets or has used them. So is it making money or losing money? Because generally you can draw the conclusion that a nonprofit organization that is showing some profit um, is increasing their cash balance, right? Now, if they're staying flat, that means they're generating the cash they need and they're using the cash they need. If they're using money, maybe they're eating into losing money. Maybe they're eating into their reserves, and you need to take a closer look at that. So that's really where that net asset number increase or decrease comes into play. You want to be looking at if there are any unusual items, income or expense, that you might want to ask more questions on. Maybe you're looking at something year over year and wow, something's much higher than it used to be. Um, you want to know that, and you want to ask questions because you want to find out, are the financial statements right? Maybe there's an error in there somewhere, or has something changed in the organizational's operational structure, or the way it's doing things that is having that outcome, and you might want to rethink that, or you might not have any control over it. For example, if it's a fixed cost and you can't help it, but the rent went up. So good information there. Trend analysis is really, really important. Looking at income statement results year over year, quarter over quarter, whatever that time frame is, and looking to see how the organization has grown, if it's grown. If it has not grown, you're going to be a little concerned. Maybe depends on the organization, but trend analysis really, really important. And then is the organization using its resources in a way that's mission focused for it? So when I said maybe the organization is pretty flat, which is just fine because it's generating exactly the resources it needs to fulfill its mission, and that's great. And then budget to actual comparisons are important too, because they help you understand how an organization is doing. Remember, we said the budget is set with the organization's mission in mind, and reaching that mission. And so if the organization, if the income statement is approximating that budget, then that's a good sign that the organization is meeting its goals and hitting its mission, assuming that the budget's been put together properly. So just some thoughts there on the income statement. Moving on to the balance sheet, because we are running out of time. We got a balance sheet formula of assets equals liabilities plus net assets. Said another way, assets minus liabilities equals net assets. I think we're all probably pretty familiar with these terms. We've probably all heard them at least. And a balance sheet shows the financial health of an organization at any given point in time. It's a snapshot. We talked about that. I do want to touch here on accrual versus cash basis. An accrual basis balance sheet will show things that either benefit the organization in the future from a cash perspective, or obligate the organization in the future from a cash perspective. So the easy examples are accounts receivable, which represent cash that someone owes the organization, and accounts payable, which represent money that the organization owes to other people. And an accrual basis balance sheet tends to be a little more useful because it allows you to look into the future a little bit better and understand what the cash position is going to look like in the future. Whereas a cash basis balance sheet just sort of summarizes what's already happened. Now, having said that, accrual basis accounting is not for every organization, but as the organization grows and expands and generates more resources, if you're not already on an accrual method of accounting, you might want to think about that. It could just capture the bigger picture a little better. An asset, I actually had someone ask me what an asset is, because we all use that term. We all think we know what it is, but what is it really? Well, it's something that is owned by the company that can be presumably converted to cash or a future benefit. So when I say, converted to cash is easy. Something like a fixed asset, so something like a desk or a building, you could sell that and turn it into cash. So that makes sense. But something that will give rise to a future benefit. Well, if you when we're talking about that, we're talking about, say, probably a prepaid expense. So if you pay for an insurance policy that's going to cover the next year, well, that next year's worth of insurance coverage is a future benefit to the organization. You've already put the cash out, and now the insurance company is obligated to provide you with insurance coverage for the year. So there's your future benefit for the organization, and we usually see that in prepaid expenses. Liabilities are sort of the opposite, and that's how much cash is the company going to have to pay in the future. So what do they owe? Accounts payable, loans, credit card balances, any unpaid sales and payroll taxes. So they obligate the organization to either use cash, the ones that are listed there are cash, or they might obligate the entity to provide resources in the future. So I'm going to talk a little bit, something like maybe the organization sells memberships, and that, similar to the insurance example, but flipped, the organization gets the cash, but then going forward, they need to provide the person who bought the membership with access to the facilities for the next year. So that would be something called like deferred revenue. And I've seen that a lot. That can be pretty common. And so that's another type of liability. It's the entity has an obligation to provide a service or a benefit of some form to somebody else, not necessarily just cash. And then equity or net assets is just the difference between the two of those. And so that is why you can take a look at your net equity and see what your resources are projected out to be. We already talked a little bit about accruals and fixed assets. I do want to touch on fixed assets here because one of the things that's important that I think can be confusing is when we talk about capitalizing an asset, and this is true both in the nonprofit world and business world. What that means is you've purchased a piece of tangible property that will have a useful life that's longer than 1 year. And so the accounting requirement for that is that you show it as an asset on your balance sheet and then you depreciate it, meaning you recognize a portion of its cost over what its useful life is. And there are some conventions around determining what the useful life is and how you go about recognizing that cost, but that's what depreciation is. It's, you can't take the cash that you just spent and recognize it as an expense all in 1 year. You need to look at it over the useful life of the asset. So when we say capitalizing an asset, that's what we mean. Then we already talked about equity and net assets. One thing to touch on here that is important for a nonprofit is that net assets is broken into restricted and non-restricted net assets. Talk about that. This is just more talk on assets. We talked about those already. And restricted and non-restricted net assets are important because remember we talked about Garth Brooks and his contribution. Well, he expected that that money that he gave to that hospital would be used for a specific purpose. And so restricted funds or donations can only be used in the way that the donor has said they can be used. And if an organization has an imbalance or a problem between having too many assets that are restricted and not enough that are unrestricted, they can run into trouble because the only way they can use those restricted funds is for their restricted purpose, which means they can't use those funds to run their operation and run other programs. So paying attention to how much is restricted and how much is unrestricted. You might have $1 million in the bank, but it's not going to do you any good if you have to meet payroll if it all has to go towards building a building in the future or something along those lines. So that's a really important metric to pay attention to, and it's spelled out in your net asset section. It'll show restricted or non-restricted. Some common ratios, the only one I really want to focus on here because I think it gets missed for organizations is the cash reserves. And you don't have to do the whole ratio. But one of the things that I think a lot of nonprofits don't necessarily pay attention to or have in place, and this is the board responsibility, is what happens if something goes really wrong. This is like having an emergency fund in your personal budget, right? In your household budget. Um, and really I sort of feel like 3 months is a good rule of thumb. You have to know what your expenses are. So step one is understand what your monthly expenses are. Fixed and variable costs can be really important here. Look at your trends, do the work, do an analysis of what it takes to keep the place running every month. And then try and build towards a reserve. This can be a goal. A lot of times you can't get there all at once, but it's a good goal to have some money in reserve in case something catastrophic happens or something really challenging happens, like during COVID-19. That was a tough time. So that's a one I would suggest. EBITDA is on here because I use it. It's actually more of a business term. And what it does is it helps to remove, it takes your income statement and removes things that are non-operational. And it's a little limited in nonprofit world. I just like to use it because it helps me understand, because cash from operations is generally not restricted, and so it's an important metric. And it helps me to look at that and understand. I pull some non-cash items out, or some items that are maybe not tied to operations. It helps me to understand kind of where I think the organization is headed from a resource perspective and being able to pay its bills. So I'm going to go back to budgeting just a little bit because it is really important in a nonprofit. I would argue that it's important in a for-profit business too, but we're talking about there should always be a written annual budget that is reviewed, approved by the board of directors. That budget should be focused on the mission. It should be put together with the objective of fulfilling the organization's mission. Encourage the management of the organization and the board to use that budget as a tool. It's a really good one. Keep it realistic and flexible. And it's not unheard of to reforecast a budget in the middle of the year. Something unusual happens. So say you get a really some program just goes off the charts and does fantastically better than you expected. Maybe it's a new program. Well, look at whether or not you want to reforecast your budget. Stop and reproject where you think you're going to be for the year. That can be really useful. It can also be a big time-consuming effort. So you want to use that judiciously, but it can be very helpful, and sometimes it's warranted. As far as where you start with your historical financial statements, and they can then and sort of build from there based on what you know. If you have a larger organization, you might have sub-budgets. Each department might have its own budget. And you might consider multiple budgets with different purposes. I like a capital expenditures budget. If you have an organization that is generating cash, so it's increasing cash, it's really important to have a plan for what to do with that cash, how to further your mission with that cash. And a capital expenditures budget can be really helpful there. A capital expenditures budget can also help you to generate funds. Say you have needed improvements. So for your building, maybe you need a new roof or something. A capital expenditures budget can offer you a really good roadmap to how do you get there? How do you get to where you can do that? That is about all I have. We've only got 5 minutes left. I apologize. As I said, I had a lot of material. If you want, these are some resources. That first link there is for the IR. You can go look up an entity's tax return and make sure they have exempt status, and you can do a search there. There's all sorts of information there. There's some more general information there on the IRS websites. So any questions?
Doesn't look like anybody put anything into the chat, so now would just be the time to unmute yourselves and go ahead and ask away.
Well, either I covered it all or I confused the heck out of you guys.
I'm going with covered it all, Dena.
I don't know. That was a lot of information. Thanks for bearing with me.
Yeah,
really
it was a lot of
appreciate
great information, and we really, really appreciate your time and effort, sharing your expertise with us. So thank you very much.
So
My pleasure.
slides and links will be available to us by email?
The ones that she has right here on the slide,
Yes.
we can definitely get those sent out to you. You won't be able to click on them when I send the recording out, which will probably be tomorrow, but maybe Thursday, but you won't be able to click on that in the recording, I don't think, but we can get those links specifically emailed to you guys. Not a problem.
Thank you.
Yeah, of course.
Happy to share.
Thank you, Dena.
Thank you so much.
Of course. And here is, if you want, there's my contact information if you want to email me.
Awesome.
If I can help you out, I will. If not, I'll find someone who can.
Perfect.
Yes, thank you.
Thank you.
All right.
All right.
Thank
Thanks,
you
everyone.
all.
Have a great day.
You too.
Bye.
Thank you for watching this summer speaker series. If you would like to tune in to future presentations or connect with this speaker or Silverbridge CPAs, please visit us online at silverbridgecpas.com.